Welcome back to Investing Talk Podcast.
Today we're looking at Beyond Meat.
As usual, before we start, subscribe, like, and comment to this video to support the show. And if there's a specific company you want us to look into, leave it in the comments below.
So let's get into the analysis. For anyone who's been tracking this company over the past year or so, the story has really been about one thing.
Crisis.
Exactly. Crisis. Heading into early 2025, the market was basically pricing in a complete financial collapse.
And it wasn't just, general headwinds in the plant-based sector. This was a company in full-blown survival mode.
It was. The situation was truly dire.
Yeah, if you were looking at the reports from late last year, that persistent revenue decline was under a microscope.
And the cash was just draining away.
So the board, they clearly decided they had to do something drastic to perform, radical surgery just to save the patient.
That's a good way to put it. And we saw that almost immediately with these aggressive cost-cutting measures that were finalized earlier this year.
These weren't small tweaks either.
No, not at all. These were moves of, pure necessity. They cut about 17% of their global workforce.
Which was what, almost 200 roles?
About 190 roles, yeah. And maybe more symbolically, they made that really tough call to just pull out of underperforming markets completely.
Specifically Japan and Australia.
Right. Which tells you they were in a frantic retreat back to their core market, North America.
And all that financial anxiety, it was just amplified by the changes in the C-suite.
Oh, absolutely. The CFO, David Lee, he departed pretty suddenly in January.
And that kind of exit, combined with a weak cash position and all that debt coming due.
Yeah.
It just fueled all this market chatter.
The chatter was about a big dilutive equity raise, right?
Yeah.
We have to sell stock just to keep the lights on.
Exactly. And that fear wasn't completely unfounded. The whole plant-based category was hitting a wall.
It was. The analyst consensus had shifted so sharply downward. They were saying this wasn't a slump. It was. It was a structural problem.
A rejection of the high price point by a lot of consumers.
Yep. The context was simple. If management couldn't fix the balance sheet and stop the cash burn, the story was over.
But they managed to fight their way out of that immediate danger zone.
They did. Which brings us to how they bought themselves some time, how they tackled that liquidity risk head on.
And the key move there was the debt restructuring.
A really complex, almost surgical maneuver they pulled off earlier this year. They exchanged their existing convertible debt for a new instrument with a very long name.
Right. The 7.00% convertible senior secured second lien PIK toggle notes due 2030.
That's the one.
Okay, hold on. That sounds like something you press in a financial emergency. For our listeners, what does P-toggle actually mean, and what did they give up to get that breathing room?
That is a great question because it really shows the cost of survival.
Okay.
So PIK stands for payment in kind.
Okay.
It means if cash gets tight, they have the option to pay that 7% interest not with cash, but with more debt.
So they can pay their debt with more debt.
Essentially, yes. It pushes the deadline way out to 2030, which is great. But it's extremely expensive financing. It's a signal that their credit quality was poor and they had to pay a premium for time.
So time is now their most expensive asset.
Huh.
They bought the runway, but they have to execute before those expensive payments really start to bite.
Precisely. And that runway only works if management shows really aggressive discipline across the board.
Which, to their credit, it seems like they have.
They have. It wasn't just about layoffs. They got really serious about cash flow. They cut planned capital expenditures by $25 million for this year.
And they got much better at managing their inventory.
Dramatically better. Inventory days. That's how long a product sits on the shelf. It dropped from a bloated 122 days down to a much healthier 89.
That's real cash they freed up.
It is. So these aggressive moves positioned them to restore margins. But, we do have to mention the elephant in the room that's still there.
The massive share count.
453.6 million shares outstanding. It means even if they get profitable, moving the needle on earnings per share is going to be tough.
But first things first, they had to survive.
Yeah.
And these actions, they delivered that survival.
Which sets the stage for the most unexpected part of this entire story.
The Q1 inflection point.
The results that came in they completely challenged that bearish outlook.
It really was the plot twist nobody saw coming. Q1 revenue landed at $74.8 million.
And that number is so critical because it was the first time they had year-over-year revenue growth since the middle of 2022, a gain of 12.7%.
The bleeding finally stopped.
And not just stopped. The growth came from the right places. North American retail was up over 18%.
And international sales rebounded by more than 30%.
Yeah.
So the places they chose to stay, they're doing well.
But the real stunner, the thing that validated the whole operational shift, was the margin story,
You're right. Gross margin expanded to 28.1%.
which is a massive 680 basis point improvement year over year. That's not a small bump. A few quarters ago, their margins were almost negative.
So what was behind that? What were the drivers?
Two main things. First was supply chain rationalization. They went from 5 manufacturing facilities down to just 3. That immediately cut costs.
Okay, that makes sense.
And second, they got a bit of a gift, you could say, input cost deflation. Soy and pea protein costs dropped 19% because of better sourcing.
Wait a second, though. 28% is fantastic, but that makes me wonder about sustainability. You're saying one driver was a one-time consolidation and the other was a temporary drop in commodity costs.
That's the right question. How much of this is repeatable?
Yeah.
Well, management maintains that about 60% of that gain is structural from those efficiency improvements. And they immediately put their money where their mouth is.
By raising their full-year guidance.
That's exactly. To between $355 and $375 million. And crucially, they reaffirmed that they expect to hit positive adjusted EBITDA by the second half of this year.
So the whole narrative just flipped. It went from can they survive to can they sustain this?
And for this to be sustainable, they need a real operational moat, something competitors can't just copy.
Especially with that high price point.
Right. And their primary defense there is their proprietary IP. They have 7 U.S. patents on their plant-based muscle fiber alignment technology.
Which is really what allows them to get that superior texture, right? It's
Yeah.
not just a veggie block. It actually mimics the chew of real meat.
That's the idea. And the data seems to back it up. An independent lab, Roche Labs, did a blind taste test.
Yeah.
And it showed an 83% consumer preference for the texture of their 2.0 burger over-the-top competitor.
83%. That's huge. That suggests the quality might actually justify that price premium.
It's their best shield against the cheaper private label stuff. But beyond the product itself, you're now seeing the distribution wins. Retailers are pulling the product onto their shelves.
The biggest one being that exclusive deal with Costco.
A huge vote of confidence. That's for their new sausage deli product, launching in over 600 U.S. locations. It's estimated to be about 15 to 25 million in new annualized revenue.
And Kroger also expanded their shelf presence by 30% across 2,500 stores.
When big retailers do that, it's because their own sales data is telling them the product is moving.
And it wasn't just retail. Food service bounced back too.
Yeah, new contracts there,
Yeah.
plant-based breakfast sandwich with Starbucks, and getting the Beyond sausage into all U.S. Dunkin' locations, that makes demand much stickier.
So all of this operational success started to shift the market sentiment,
You saw it in the institutional signals, for sure.
starting with the insiders.
Yep. The CEO, Ethan Brown, he bought 20,000 shares in March, his first big open market buy in years. The CFO bought shares too.
When management starts buying with their own money, right after a painful restructuring, that says a lot.
It does, and the big money followed.
The institutional funds.
In the Q1 filings, you saw Vanguard increase its position by 40%. BlackRock added a huge new position, 2.1 million shares. This is not what you see in a company that's collapsing.
And from a purely technical standpoint, the charts were confirming the shift as well,
You had that golden cross formation in April.
which is a pretty significant signal for chart readers.
It is. It's a key reversal indicator. It's just when the 50-day moving average crosses above the 200-day. It basically confirms that short-term momentum has overtaken the long-term downtrend, a potential new bull trend,
So yeah, the fundamentals of the technicals finally lining up.
which led to a wave of analyst upgrades. They stopped pricing in disaster and started pricing in a recovery.
Okay, so if they've navigated the survival phase, what are the near-term catalysts we should be watching for now?
The big one is the Q2 earnings report on July 24th.
Right. The consensus is looking for about $87 million in revenue.
Yeah, and a much smaller adjusted EBITDA loss. Something like negative $10 million versus negative $29 million a year ago. If they hit that, it validates the Q1 margin story.
And then right after that, there's an investor day in August.
Also crucial, that's where management is expected to lay out the full roadmap. New products, maybe updates on cell-cultivated partnerships. It gives the market a reason to look beyond just this year.
Now, despite all this momentum, we have to talk about the risks.
Of course.
Number one has to be the consumer sensitivity to the price. Plant-based is still 2 to 3 times more expensive than conventional meat.
It is. And if the economy tightens, that's a discretionary purchase for a lot of people. It could get cut from the grocery list.
And the second major risk is just execution.
Turnaround stories are hard, full stop.
Management has to maintain this new level of discipline. If they slip on those gross margin targets, the cash burn comes back.
And they're right back in that corner, potentially forced to raise capital at a low price, which hurts shareholders.
That said, it feels like the current valuation already reflects a lot of that risk. The key takeaway for me is that they've gotten through the most dangerous part.
They absolutely have. The financial collapse scenario is, for now, off the table. They have clear operational momentum.
And the true test will be sustaining that margin expansion as they roll out at Costco. If they can keep hitting those gross margin goals for the next couple of quarters, you could see a significant re-rating of the stock.
It could shift from just a survival story to a legitimate long-term operational turnaround.
The runway is set. Now they just have to fly. Watch that July earnings report to see if they can maintain this performance.
We appreciate you joining us for this analysis of the recent catalysts and financial shifts.
Subscribe, like, and comment to stay informed on our next analysis. We'll see you next time on Investing Talk Podcast.